Morning, everybody. It's 10 a.m. on Tuesday. That means it's time for our webinar. Good to see everybody. I am always happy to be here on Tuesday mornings. I look forward to it really all week. And it gives me some time Monday and Tuesday morning to go through some analyst reports and market updates and some planning resources. So you folks are really good for me. And I hope you get a lot of benefit out of this as well. So good to see everybody. I hope you enjoyed, for those of you who joined us last week with David McKnight, I hope you enjoyed that webinar. We've gotten a lot of great feedback about that. And, I can't believe it was a year, as I said to Dave. So we had to do that more often, maybe every twice a year, but we're going to be seeing him, right? He's going to be here locally on the 27th. It looks like tentatively we're going to be at the Newtown Theater. It is a really neat venue. We've been a supporter of the Newtown Theater for several years. I grew up going there. We had my mother's 90th birthday party there. If you've never been there, it'll be a great opportunity. Parking will be a little tricky. There's municipal parking down the street. You might have to walk a block and a half, but that'll be a really great night. We'll have some books from Dave. You folks who regularly are on the webinar, who are in our span of invitations, you'll have a VIP event before that event where you can meet Dave, spend some time with him, talk to him directly. So that'll be neat. So I hope you can make it. That'll be April 27th. Make sure you put that in your book. And tentatively, we're still working out something with the sound. The theater just redid their entire interior. We helped raise money. Boy, it was probably a decade and a half ago now for some sound and air conditioning in there, but I know they just kind of gutted the whole inside, and I haven't been there yet, but it'll be fantastic if we can pull it off and have it there. So, but I think we're there. I think we're about 90% there. All right, so we should have everybody on. Just raise your hand, please, if you can see me and hear me okay. Great, thank you very much. Hi, everybody. All right, so we talked about David coming up. We talked about his last week's appearance. If, of course, you could make it that night, you can listen to the recordings. I don't know if it's on the webinar or on our website yet, but let's see, not yet, but we'll be in a couple of days. We've had some slow going with our compliance review lately, but we're getting caught up on that. If you access our website under events and webinars and do a drop down, special webinars, and of course our weekly webinars are up there, special webinars, you'll be able to see that. And hopefully by the end of the week. It's Tuesday. I don't see any reason why we can't. Speaking of our website, the new tax tables are up. So I told you they'd be up for about another week or two last week. That happened a little faster than I thought. So if you still need 2021 tax tables and you did not have a chance to download them, send me an email and I can send it to you. But I'll just share with you while we're talking about it. I'm going to share my screen with you. And here's where I went. I went to Attleboro Wealth Management. I slid over here to the slot corner. I get these charts. I don't produce them myself. I get them right from Ed Slott's group. So I want to give Ed the credit for them. So I put them in here. And if you scroll down, you'll see beginning the 2022 tax planning. Those of you who have been doing this for a while now, you recognize these orange charts. It shows your federal income tax brackets, that's for ordinary income, your capital gains, transfer taxes, trust tax rates, standard deductions, qualified business income, qualified charitable distributions. I think that's part of our discussion today. Roth conversion planning ideas. These are, always beneficial. We're going to today in our financial planning topic, we're going to talk about why Roth 401ks and Roth IRAs are so important and some fundamentals about Roth. We had the 2022 Medicare income planning, the dreaded IRMA chart, right? Income related monthly adjustment amounts. The updated IRMA numbers are in here. Retirement plan contribution limits. So the 401k contribution limits and overall retirement plans, they increased. Some of them increased this year. IRAs, however, did not. You'll see here 2020, 2021, and 2022 are all the same. You can only contribute $6,000 a year if you qualify. That means if your income's not too high, in the case of a Roth, and it's non-deductible in the case of a traditional. But if you're under 50, it's $6,000. If you're over 50, there's another $1,000 you can put in for a total of $7,000. These are the phase outs we talked about, and there's some other things in here that I just don't want to. Oh, let me bring this to your attention. This is the new uniform lifetime table for taking your RMDs. So now you see this starts at age 72 and it uses the new life expectancy. And it does show, in this case, the percentage of account balance. So that's going to give you a pretty accurate amount of what percentage you have to draw out. And I like that because even though it really isn't a percentage, you've got to use this factor here, but you'll see how it increases. In the beginning, you have to draw about 3.65%. And if you live till you're 90, that goes all the way up to 8.2%. So that escalates, pretty quickly every single year, but that just shows you how fast the IRS wants your money. So I hope that's helpful. Feel free to download it. All you have to do to download it is click on the button here on each one of them, and you have to enter in your name and email address, and then you have it, and it's yours to keep. Okay, let me stop sharing. So what are we talking about today? Well, we got to talk about the markets, right? First of all, just a general overview. I want to say, don't panic. I'm looking at the Dow Jones Industrial Average right now on the TV. It's down 700 points. Yesterday, we were down close to 1,000 points. It may have dipped into 1,000, and then we closed positive for the year. I told you in the beginning, very beginning, one of our first webinars, that I believed it was going to be a very volatile year. And I also believe that we're going to end the year slightly up or down for the year. So here we are. We're in the midst of it. There's a lot going on out there. We've got potential crisis overseas, right, with Russia and Ukraine. We have more COVID, although that seems to be better right now. Rising interest rates. The Fed has talked about raising rates aggressively 3-4 times. Some people are talking about 5 or 7 times. What does that mean? It's potentially dampening the economy. They're fighting against inflation. Inflation numbers are not big. They're huge. They're huge. And they're going up every single month that we're seeing it, right? So it was 5.4, 6.2, now 7. So there's a lot to combat. So you've got to set your foundation. I'm not going to belabor that again today. I'm not going to talk about it today a lot, but set that foundation. Make sure you have your account set up in the right way. If you're clients of ours, you're structured for this already. Remember that fluctuating foundation in San Francisco. You might get some crumbling, but the building shouldn't fall. If you're in the process, and I feel bad, we have a couple clients that are just in the process, and we're not quite fully investing them yet. Still doing our planning and the things that we need to do. So that's concerning. Some of them are sitting in a lot of cash, and that's okay right now. But some of the ones that are in more aggressive positions than probably they should be, I worry about. So, but we'll get that straightened out. And it's going to be, listen, the volatility that we're seeing here, I think, is going to be like this for some time. I was actually surprised when I saw the market go back up yesterday. I expect to see us in correction territory. So that is negative 10%, right, in the general market. So down 10%. We don't, looking back the past 3 years, the Dow Jones Industrial Average returned, doubled, right? Remember, we talked about this. So over the past 3 years, it doubled. It's unsustainable to be able to keep up that kind of pace. So we make sure we're invested across not only just all types of investments, but all types of timelines, right? Make sure that you've got the cash you need for now and the conservative investments, and you fan those out as you need them going forward in your lifetime. And that's going to help you eliminate the worry that we have during these times, and also eliminate that fear of missing out so that you have the growth that you need in your portfolios. So I'm going to come back to the slot update since we're talking about the markets, and I'm just going to share with you where we are so far this year. So I'm going to make this a little larger for myself. So the Dow Jones Industrial Average year to date is down 5.63% year over year. From this time last year to this time this year, it's still almost 12% positive. Just this past week, the week closing, what was that? Week closing the 21st The Dow Jones Industrial Average was down 4.55%. That same week, the S&P 500 was down 5.67. The NASDAQ was down 7.55. The global index was down 2.23. All the indices, all the general indices were down. Bonds were up slightly last week, 0.05%, but down so far for the year, 1.77% down so far for the year. And that's one of the troubling things right now. When you open your statements, when you get them, a week or two into February, or you get them, you're able to download them, however you get your statements, or you log on online, you're going to see red. And unfortunately, you may see red on both sides, right? Bonds and stock. And this is a difficult time. You all know that the bond portfolios concern me the most, and we're going to talk a little bit about that. There was a big boost in a surprising boost in rates, and or curve, I should say, the yield curve, and it's difficult to manage that for bond managers. So I'm not surprised at what I'm seeing with the bond index. We've just got to keep our allocations, make sure that they're strong, review them, and make sure we're in the right places, and we'll continue to do that. So let's go back to the slide updates, and then we'll come back to analyst reports. So we've got a couple things today. The first is about another one about qualified charitable distributions. So these are becoming more and more popular. You can do up to $100,000 after you reach age 70 and a half. That still is under 70 and a half, even though Rmds now, required minimum distributions, are 72 years old. So it's a little strange thing in the law, but no reason to change it. It's beneficial for you folks. So in this case, this person writes to Sarah Brenner, who I hope you have the opportunity to meet soon on a webinar. Sarah's going to talk to us about trusts as beneficiaries to IRAs. This person writes, my mother died in 2021 in her early 90s. She was using $100,000 of her traditional IRA required minimum distribution as a QCD, a qualified charitable distribution, right to the charity, so you don't pay tax on it. It's a way to take that required minimum distribution and not pay tax on it in order to fulfill her 2021 charitable commitments. I did a QCD after her death. So mom died, daughter inherited the money. She did a QCD out of the inherited IRA to fulfill what she believed was the mother's 2021 charitable commitments. Because I am not 70 and a half yet, my CPA tells me I need to include IRA withdrawal in my income and take a charitable deduction because the assets had already moved to my inherited IRA account. Is this correct? Is there an exception I am missing here? So a lot of times CPAs are wrong. I'll just tell you, if this isn't something they deal with all the time. We field questions from people all the way. Hey, my CPA said this. I can only do a $7,000 Roth conversion. That's wrong. That's contribution, and that came from a CPA. What was another recent one? It also had to do with a Roth contribution and how contribution, how conversions impact the income limits for Roth contributions, and they don't. So this happens, not a bad thing. Everybody has their specialties, and just because you're a CPA doesn't mean that you specialize in tax efficient planning. You might be great at tax reporting and filing those taxes, but tax efficient planning is a completely different thing. In this case, however, Sarah writes, your CPA is correct. The IRA beneficiary can do a qualified charitable distribution. However, to be eligible, the beneficiary must be age 70 and a half or older. So once you inherit that money, it's an IRA beneficiary. You're an IRA beneficiary holder. You must be 70 and a half or older. Now, it can't be done in the year that you turn. Like if you turn 70 and a half in June and you think I want to get this done in April, it's not going to work. You have to wait until you're 70 and a half. If you're not old enough to do a QCD or distribution, will be treated as taxable. If you're eligible, you could take a charitable deduction. So that's more complicated, of course, making that charitable deduction work. It's not likely that that's a big one, $100,000. So that probably didn't work out well for that person. This is a good one. So this has to do with aggregating required minimum distributions. Sometimes you can, sometimes you can't. So this question asks, I cannot seem to find the answer anywhere. So perhaps you can address this in one of your newsletters. This person did the famous financial Google search and couldn't find the answer. More and more now, there are inherited IRAs of different types requiring RMDs, which is again required minimum distributions. I know you can treat them as combined for calculating RMDs, but what if they are different types? Really great question. For example, an inherited traditional IRA, the required minimum distribution is $3,000. An inherited Roth IRA, the required minimum distribution is $3,500. The writer says, can I just take all $6,500, that's the total of the two RMDs, out of the traditional IRA and leave that Roth IRA to grow, or the other way around? Or must I take RMDs from each separately since they are not the like? They're not the like type. This person's name is Ev. So Sarah writes back, if required minimum distributions are due, they may be able to be aggregated. However, this is only possible when the IRAs are the same type and inherited from the same decedent. In your example, if a beneficiary inherits both a traditional and a Roth IRA, these RMDs cannot be aggregated. So you can't aggregate, you can aggregate some, can't aggregate all. You cannot aggregate IRAs and retirement plans. They are completely different. That happens all the time. People come in and they say, well, listen, I've got $2 million in my 401k and I stopped working a few years ago. I'm over 72 now. But I'm not taking any distributions out of that. I'm just taking them out of my IRA. Well, that's wrong. You owe a lot of tax and penalties on those distributions that should have been taken out of this 401ks, potential penalties. Ed's newsletter came out just this morning for February, and there's some good bullet points about contributions, IRA contributions. And there's another section about gold in an IRA. Someone had asked about this on the webinar on Wednesday night, and he scheduled an appointment. I'm assuming he's going to want to talk about that when I talk to him this week. But let me talk about contributions. These are what Ed calls nuts and bolts. So a prior year, 2021 IRA Roth contribution can be made up to the tax filing deadline. So that's April 18th of this year. There is no extension beyond that date for a contribution. IRA contributions have no bearing on how much a person can contribute to a workplace plan, such as a simple or 401k. So if you meet the requirements, you can contribute. A spouse with little or no compensation can make an IRA contribution based on his or her spouse's compensation, as long as the couple files a joint tax return. I do hear this all the time. I say, well, if wife is working and husband's not, say husband's already retired or just not working, and there's a couple different ways to get money into a Roth IRA, for example, I say, we can make a contribution into the wife's IRA, and we can also do a spousal contribution as long as you file a joint return into a Roth IRA. So people forget about that. And I often hear, oh yeah, I didn't think about that. Person with earned income can always contribute to an IRA, but a traditional IRA contribution is not always deductible. If you go back to those tables I showed you on my website, if you make too much money, you can contribute to an IRA, but it's not deductible. There is no Roth IRA contributions are never deductible. There is no age limit for making a traditional or a Roth IRA contribution. There is an IRA phase out. We talked about that. One spouse is covered by an employer plan and the other is not. The uncovered spouse is permitted a higher phase out range of $204,000 to $214,000 for 2022. All right, so they're just some bullet points about IRA contributions. Let's talk about gold. There's a lot of advertisements on the internet. I see them, when I go on social media, and I see them I often have CNBC on in the background, and I hear it all the time. So people write about it and ask about it. So this is something that I generally, because it is difficult. So Ed writes, while gold coins and bullion are permitted IRA investments, there are strict We've talked about that before. It's very, very important. Other options of gold in an IRA include stocks of gold mining companies, precious metals, mutual funds, and gold bullion ETFs. So you can buy these things via ETF. You just don't own the metal. Some people just want to have those gold coins in their hand, but again, you have to have them held with a custodian. If gold bullion ETFs are held in Roth IRAs, what could have been a 28% tax on any gains might be avoided entirely via tax-free qualified distributions. So that's just, he's talking again about the benefit of the Roth IRAs. Case, the court ruled that Mrs. McNulty took possession of the AE coins. This is something when I finish up my my twice a year Ed Slot group education classes, we're there for a day and a half or 2 days. I often have these court cases to review. So he's reviewing this court case. Miss McNulty took possession of the coins and had complete control over them. So the IRS said, if you have possession of them, you got them in a box under your bed or something, even though you're calling an IRA, that you bought it with an IRA, it's held in your IRA, even if a custodian, says it's considered an IRA. If you have possession of them, then it's a taxable distribution from the IRA. One way a taxpayer can show they acted with reasonable cause and in good faith is to rely on professional advice. Websites can be considered advertisements and not professional advice. That's just a little disclaimer he gives. Now, the last piece here for the Ed Slot section is IRA trusts as beneficiaries. So again, hopefully over the next couple of months, we'll have Sarah Brenner on to talk more about this. A couple bullet points. If you want to name a trust as a beneficiary, it may be prudent to use an irrevocable trust, right? So the trust can't be changed. He's citing another court case here, a significant court case, Commerce Bank versus Bolander in 2007. Ruled that a deceased IRA owner's accounts payable to revocable trust were vulnerable to the creditors of that deceased IRA owner, if the probate estate's assets were inadequate to satisfy valid claims. So he's saying because what that court case said is because it was a revocable trust, the owner could have changed it at any time. It didn't protect the assets. So they're saying potentially, and you want to talk to an estate attorney about this, potentially have those in an irrevocable trust. Depending on state law and relevant court decisions, choosing an irrevocable trust generally provides more protection from creditors of an IRA owner after death, as well as from creditors of the IRA beneficiary or beneficiaries. So good points from Ed. We always appreciate that. That was a good newsletter they had this month. And now we're going to go back to the markets. Let me just see if there's any questions before I move on. You guys are quiet. No questions. Good. The first, I thought there were a couple interesting pieces from the Wall Street Journal. And this one fella, Jason Zweig, he writes The Intelligent Investor, and I enjoy reading his columns. And he wrote today, I think this came out this morning, and he was talking about market fluctuation. So I just grabbed this one section that appealed to me out of the article, just to remind us all about, what goes on when we see, the Dow's down 566 points today. So there's a few things that happen. We all start paying attention, right? I went in to see my chiropractor yesterday, and the guy behind the counter is talking to me about the markets, and people are just, now we're paying attention to it. We're putting a lot of energy into it and paying attention. Well, CNBC knows that, right? And whatever financial channel you use or website you go to, they track these things. So they know what to give us to get our focus back. There's also automatic trading mechanisms that are very prevalent now. So as soon as things start to go down or hit a certain point on the upside, trading is automatically triggered. So that's why you sometimes see this fast and furious activity down, because these aren't humans making these decisions, they're computer programs. So, and they just happen. So be mindful of that as well. And Jason writes, I don't know whether we're on the cusp of a cataclysmic decline or whether this is one of the market's normal seesaw rides. I think it's probably a normal seesaw rides, but those seesaw rides can make you pretty queasy. What I am sure of is that after 2 years of being cooped up at home with nothing to do but stare at market charts, a lot of my colleagues in the financial media are bored stiff. So reporters and editors will seize every opportunity to turn market molehills into mountains and to extrapolate every drop into a correction or bear market. So Jason, who is a journalist, says, we've got a lot of bored journalists out there and market journalists, and they're going to make hay out of this. So just be aware of that when you're paying attention to what's coming at you from the internet and coming at you from TV. You know, we get it everywhere. It's just, it's, you know, it used to be the evening paper, the morning paper, or whatever. Now it's the TV screen hanging there. It's these darn things we walk around with, and they're popping up notifications. So, you know, whenever I'm on a call or on a webinar, I have to, my phone's always on silent, where I don't even get any kind of notification unless I'm waiting for something for my wife or children or something. Nobody calls me here during the day for work related things. They call my office number because I don't check my phone during the day. I have to put this thing upside down because, you know, you get constant notifications. And yes, I know you can turn them off. All right. So this is a good section today, talking about what happened at Vanguard. So there were some capital gains that came out of funds that weren't expected for investors. So specifically, the Wall Street Journal was talking about some Vanguard target date funds. Now, I'm a fan of Vanguard investments. I use them in my portfolios. You folks know that. But this is an example of knowing what is inside of your investments and how they're going to work. So these are the Vanguard Target Retirement Funds and an effective capital gains. Now, you might say, well, wait a minute, Mark, there are no capital gains inside of a retirement account. And that's true, but people are buying these retirement funds outside of retirement accounts, regular taxable accounts, because they look at it as an easy, cheap, efficient way to have professional asset management without worrying about it. But what happened is Vanguard Target Retirement 2035 and 2040 funds distributed 15% of the total assets at capital gains, which are taxable outside of retirement accounts. One person they talked to had to pay $105,000 in tax that they weren't counting on, this is something that you've got to pay attention to. So how do you do that? There are schedules. First of all, know what you're investing in, and there are schedules that come out before the end of the year, typically, of what those embedded gains, they're called. What happens? That stinks. Get a big tax bill now when the markets are down, but you can get a big tax bill from a mutual fund with embedded gains, and the fund be down for the year. So the fund can be down 10% for the year, and you still have to pay tax on gains. I know that doesn't make logical sense, but that's how it works. All right, BlackRock is talking about the Treasury. So Treasuries are bonds issued by the United States, right? And we issue a ton of them, and we also buy back a ton of them. That's one of the problems we have right now with our monetary policy and why inflation is as high as it is. And I would argue why labor is as difficult as it is. So BlackRock is reducing, this is a difficult sentence, I had to read it twice. We reduce our underweight of U.S. Treasuries after the surprising yield surge this month, while still seeing the direction of travel for yields as higher. So what does that mean? Reducing the underweight of U.S. Treasuries. So they're going to increase their holding of U.S. Treasuries, right? Reducing the underweight. It's like a double negative. But they're talking about the surprise, and I'll actually share with you. And then they said bond yields hit highs and stocks fell last week. The view of the yield surge as a reallocation away from government bonds, and not necessarily, we view the yield surge as a reallocation away from government bonds and not necessarily bad for equities. So they're saying people are taking money out of bonds and purchasing equities, maybe even putting them in cash. But they don't see that as bad for stocks. Equities are stocks. The Fed is meeting this week amid market expectations of aggressive tightening. Tightening, just means raising interest rates. More than 1/5 of the S&P 500 companies are reporting also this week. So they included a chart of the yield curve. I'm going to just share this with you quickly. I know this is kind of getting technical, but I want to show you what they're talking about. So hopefully, can you see my notes right now? And you see these two. Thank you very much. So this is, the yield curve, and it shows, this is 1 year, 2 year, 5 year, and 10-year Treasury bonds. So ideally, when you have a normal yield curve kind of like this, there's a little bit of a slope here, but you get more interest. These are yields or interest rates, just simply. The longer you hold these, the more interest you get. That's what makes sense. And this is as I said, pretty close to a normal yield curve. It should just kind of go up and increase. There's got some flattening here. Sometimes it's what they call inverted, where it goes the other way, right? So you're getting more yield for shorter term bonds. But you'll see this is December 2021, this gold line, and then the red line is January. So that is a big gap for a short period of time, is what BlackRock is saying. So, that's what's causing the downward pricing on bonds, because as interest rates go up, bond prices go down. Typically, depending on the fund, they can go down a lot, but that's what BlackRock is talking about. I hope that's helpful, or at least somewhat enlightening. All right, let's now. I think we're going to shift to the planning phase. Let me see if I have anything else. No, let's talk about why Roth IRAs are so darn important. So I'm going to pull up my whiteboard. You know the deal. I'm going to share. I'm going to draw, and I'm going to look down, and hopefully you'll follow along. Okay, one more time, I think. Raise your hand for me if you see my whiteboard. It says financial planning topic. Why are Roth 401ks and Roth IRAs so important? Thank you, everybody. So let's not forget what we're working with here. Let's draw our buckets. So our first bucket here is taxable. Our middle one is tax deferred. And our last one over here is tax free. So taxable, that's what we were just talking about, right? So that Vanguard 2035 retirement fund, people were holding over here, right? And it's set up to be held over here. And now Vanguard released 15% of their holdings and as capital gains. That's a big number. And now, ironically, most people will have to pay, let's just say, if you had $100,000 worth of gains in that fund, and they're embedded gains. So it's not even like you sold the fund. They just said, okay, here are your section of the gains. You're going to pay 15%. Most people, it could be anywhere from 0 to 20%. And then there is that surcharge of 3.8% for single filers greater than $200,000 of modified adjusted gross income, and married greater than $250,000 of adjusted gross income. So your tax could be as high as 23.8% on your capital gains, and you had no control over that. That's one of the drawbacks of mutual funds, and one of the benefits of exchange traded funds, because you don't have those embedded gains. So that's taxable. So anything that comes out of here, let me just clean this up. Anything that comes out of here, you get a 1099 for, and you pay, that would be for dividends, interest, long-term capital gains, short-term, I just went back, short-term capital gains, and anything that comes out of there, you pay tax on. Tax deferred, you promise to pay later, right? You're like Wimpy from, his name Popeye, promise to pay later. So you get a break now. You either don't pay tax if it's pre-tax, but you promise to pay later, right? When I take money out of here, when this pierces here, well, then you get a 1099-R, and you pay whatever the tax rate is, right? Whatever that future tax rate is, when you take that out is when you pay. Tax-free, you pay now. When you earn the money to either go into a Roth 401k, you pay money on that tax as you earn it, and it goes in after tax, and any growth you have is tax-free. So you pay now. If you do a conversion or you do a contribution, you pay that tax now, and no tax later. So that's and tax-free. There's only two things that are truly tax-free, as we know. Anything Roth, right? So Roth 401k, Roth 403b, and Roth IRAs. So anything Roth and some properly structured cash value of life insurance. David McKnight refers to these, and others refer to these as LIRPs, Life Insurance Retirement Plan. David wrote that book, Looking for You LIRP. So that is tax-free. Obviously, we know that you have a mathematically ideal amount to have in each one of these buckets. And this taxable bucket for most people is 6 months to 1 year of your expenses. Tax deferred is an amount that creates, an amount that creates a required minimum distribution that is less than your standard deduction. So if you can do that, if you don't have any other income, no pension income, no rental income, things like that, then you can keep potentially an amount of money in here. So there's an X for each one of these, and that's depending on you. Once you determine what your amounts are that you can keep in each one of these buckets, then everything else, right, should push over to tax-free. So they're the fundamentals. So pay your tax now, no tax later, or promise to pay later, pay no tax now. The worry is what a tax rate is going to be in the future. So we're going to talk more about that. So when we're talking about so how can you get money over to tax-free? Today, we're talking about Roth only. Next week, we're going to talk about cash value life insurance. So we're going to move this down here, and we're going to talk about that. Next week, I'm also going to use the LERP. But today, we're focusing on what happened to my green, the Roth. So how do we get money? I'll come back here. How do we get money into a Roth IRA? Well, if you have a Roth 401k, remember the tax tables I shared with you. Where the heck are my tables? Hopefully I didn't close it. So here's our tax tables and how much we can put in. Now remember, if for 2027, that's not drawing on here. So I'm right. I hope everybody can see my cursor moving here. I'm right here. For some reason, I can't draw on there. 2022, on the right-hand side, employee salary deferral limits for 401ks and 403bs. For 2022, you can contribute, if you're under 50, $20,500. If you're over 50, another $6,500 for a total of $27,000 into your traditional 401k or your Roth 401k. The great thing about the Roth 401k the Roth 401k is that there are no income restrictions. So if you make $1 million a year, you cannot contribute to a Roth IRA, but you can contribute to your Roth 401k. And if you can contribute to a Roth 401k and you're below the income levels for a Roth IRA, can you contribute to both? The answer is yes. So that's a really good situation. Don't forget, if you have a spouse and you're below that, you can also contribute for your spouse below the income thresholds. And the income thresholds are down here on the bottom left. Roth IRA phase out limits for contributions, married filing jointly, and single or household. So refer to these tables if you have questions. So the one way to get money over is use this bridge here, contributions. So either via a 401k up to $27,000 or a Roth IRA up to $7,000 if you're over 50. That's one. Well, the second way, I'm going to have to come down here, is conversions. So contributions have limits. Conversions have no limits. If you make $1 million a year, you can convert as much or as little as you'd like. So we have to find that path to get funds. Conversion is take your tax deferred funds and you move them over to tax-free, right? And most people do it via a schedule. So let's make this a little less messy. Maybe, no, that's going to make it more messy, but you get the idea. You push it over on some type of schedule that works for you. Can be 5 years, 10 years, whatever is best for you, because you have to determine the amount of tax you're paying for those conversions or for those contributions. So for the contribution, when I say to people, start making your your contributions to your Roth 401k, that's what makes the most sense. I always warn them, but just be careful because you're going to get less in your paycheck. So if you're used to X number of dollars in your paycheck and then you start making Roth contributions to your 401k, that amount is going to be less because you're paying tax on that money, right? You're not getting that tax deduction. And the benefits of one of the first things why Roth is so important to planning is control. When you're using the Roth IRAs, anything tax efficient, but today we're talking about Roth IRAs, Roth 401ks. You have control over the tax you pay. Control over tax you pay. Because if we have to wait and promise to pay later, what's going to be your tax rate in 10 years? Is it likely to be higher? I think everybody on this webinar thinks that it's going to be significantly higher. So if you're going to invest your money, let it grow, is it better to know what the cost of that money is to you, or to be uncertain going forward? Because let's just drop down and give us some new boxes. So here's our taxable, tax deferred, tax free. I'm just going to initial here. If you have $1 million in your tax deferred bucket in your IRAs, you've heard me say this before. How much of that is yours? You might say, well, wait a minute, it's mine. It's in my name. It's all mine. That's not true, because you have that agreement with the IRS that you're going to pay later. If 25% of that is yours, or is the IRS's, then you only owe what, 750,000 of that. And the problem is, of course, if and when taxes go up, if this becomes 35%, well, you own less of your IRA. So I hope that makes sense. Now, this is usually when someone says, yeah, but it's going to grow in the tax deferred. So if it grows to $2 million, wouldn't I own more of my IRA, Mark? Well, not really. Your IRA would be worth more, but the amount you own, the percentage amount would still be the same. So, and then people say, well, wait a minute. If you're telling me, let's say you can keep, because of that calculation, you can keep, as an example, $200,000 in your IRAs without having to pay tax on those distributions, because you create a required minimum distribution that's below your standard deduction. So let's leave that amount in here, 200,000. And then you convert 800,000 over time to your tax-free Roth IRA. Well, people often say to me, well, what's the break even on that? Well, what they mean by what the break even is if my tax, let's make this a little simpler. If my tax is 20% on that conversion, people think you have to earn 20% to get back to the million, and it wouldn't quite be that. And that's your break even, or maybe it's somewhere in between. Maybe it's I only have to earn 10%. But the reality of it is your break even is zero. Your break even happens immediately once you do it. Because for there really to be a break even, you have to assume that you're never going to pay tax on this $1 million. What do I mean by that? Let's do the math. If I told you, if you came to me and you had $1 million in your IRA, and I said you should convert $100,000 this year, it mathematically makes sense for you to convert $100,000 this year. And if you're in, so let's take that $100,000. And if you're in, and we're going to compare it over here. So this is traditional IRA, and this is Roth. So traditional IRA and Roth IRA. So we have that same $100,000. Let's go to the Roth. You pay 20% in tax. Well, you end up with $80,000 after tax, right? Then now, how much do you own in the Roth IRA? Well, you own $80,000. How much do you, at 20% tax rate, the tax rates are the same today, you own $80,000. Now, what your question was, or maybe, well, wait a minute, what if it grows? Then I own more. Okay, well, let's give you some growth. Let's assume you average 7.2% a year times 10 years. That's doubling, right? So you would earn another $100,000 for $200,000 now in your IRA, right? Now, if you took the entire thing out, it's just, and we sometimes you have to do that, right? If you need to spend $100,000 today, at some point you're going to have to spend $200,000. So if you took the entire thing out and taxes never went up a nickel, and the tax rate is still 20%, right? Your $200,000 less 20% leaves you what? Well, that's $160,000. you have to assume that you're going to invest the same way, right? You got the same growth in your traditional IRA. There's no reason not to invest at least like your traditional IRA. And the Roth IRA, you can, whatever you invest in a traditional IRA, you can invest in a Roth IRA. So assume you invest the same way. Well, with the $80,000, you get the same rate of return, 7.2% times 10 years. That gives us, that doubles. That's another $80,000. That equals $160,000. It's the same. It's the same. So your break-even amount is 0%. The only question is tax. So if taxes go up just 1% and instead of 20% at the conversion, it's 21%, is this going to be worth more or less? The answer is it's going to be less than $160,000. So now your break even begins to be negative, right? You're much better off over here. And we know it's not going to be a little bit. We know in the next 10 years, our studies show that the average, we believe that the average middle-class American will be in the 40 to 45% effective tax rates. That means after your deductions, after all that, this is what your tax rate's going to be. So big difference. So we certainly want to push as much as we can over to tax-free via Roth, or if you can, cash value life insurance. So I hope that makes sense with you. And if you use our method of account segmentation, where we have that timeline, right? When you retire to when you're no longer here, and we develop portfolios for each stage of your life. You know, you've seen this before. I'm going to just go through it quickly, where these are conservative and these are more aggressive over here. Well, most of the time, and these are your timelines, right? 0 to 3 years, 4 to 6 years, and it continues like that. Most of the time, the more aggressive portfolio is where your Roth lives. So it's likely that you may have higher returns in your Roth. Therefore, it just compounds that benefit. So I hope that all makes sense. So control. Why is it so important? Because you control what you pay. You pay the tax rate you choose right now, because you know what the tax rate is now as compared to what it's going to be in the future. And that is the long and short of it. There are other things. It's certainly, of course, going to benefit your heirs. You know, there are other reasons to have funds in a Roth, but it's really, why is it so important? It really comes down to that one answer, and that is control. Control over what you have to spend, how much you own, right? Because if this grows to $2 million, you own less, and you less and less and less as tax rates go up. So if you believe tax rates are going to go up, then the amount you own in a traditional IRA goes down. If tax rates go up, the amount that you own in a Roth IRA stays the same, right? Same amount of growth, you're going to greatly outweigh the Roth advantage. So it's really simple, comes down to control. All right, I see a question. So let me answer this question. Where'd you go? Okay. Oh, Walter, this is going to be a good one. Hold on. And now, okay. So Walter, this is a long one. Let me see. Let me put this up so I can read it. Walter writes, FYI. And now a recent study suggests that higher income savers are also earning better returns in their Roth IRAs than their counterparts with less income. In fact, the authors found that while those with less than $200,000 in income had average annual returns of 3.6% in their Roth IRAs between 2004 and 2018, those who earned more than $200,000 had an 8.5% annual return. Wow. Walter, I'd love to see that study if you don't mind emailing it to me. Interestingly, the gap in returns in traditional IRAs was significantly narrower, suggesting that higher income individuals are specifically putting assets with higher return potential in the Roth IRAs. And that's what we're seeing. So we move, it's just by planning. This is not just a rule of thumb. By planning, when we determine, when I go back, let me close. Oh, you know what? You can see that. I apologize. So everybody knows your last name now, Walter. They don't have your phone number or anything, though. when we go back to, where's my segmentation? Where did I do that? When I go back to here, the segmentation, this is not standard for everybody. We determine by planning what funds fit in these corridors. And then we determine, well, if these are going to be Roth and we're not going to need these, we've got 4 to 6 years, we got 7 to 9 years, and then we have 10 to 13 years, let's just say, and then we have 13 plus years. Well, if we're not going to need these for 10 years and 13 plus years, shouldn't these be nearly 100% stock? Well, the answer is probably, depending on how you feel about it. And I can probably make you feel better about having 100% stock if you're not going to need the money for 10 or 13 years, because that helps eliminate the worry about it. Think about right now, market's down, whatever it's down, it's commercial. I don't see it right now. I don't have my ticker screen up. If markets are down 10% and you aren't going to need that money for another 10 to 13 plus years, is that going to keep you up at night? Probably not. So that's where we tend to see more money flow into those Roth IRAs. But that comes out of planning. This is not a blanket statement of you should have all your longest term money in Roth IRAs, because we need to fund things here too. So your Roths might start kicking in here in 4 to 6 years. Who knows? You might start using them here. I don't know, but that's what comes out of planning. So good point. And I'll say that I think folks with higher income tend to use professionals also more. It's certainly shown over time that having professional help nets you higher returns. Let me see here. I think when I do that, you also can see everything. Gerard, hey Gerard, when current tax rates expire, the new rates will be guaranteed to be raised by 2 to 3%, built-in increases at a minimum. Yeah, absolutely. And it's a little worse than that, Gerard. It's not just the rates, it's the income levels. The income levels drop dramatically to hit higher rates of 28%. So I think it goes up to 100. And I have the chart here in my drawer, but I'm not going to dig it out for 2017. I think what is now $326,000 for a married couple filing jointly at the top of the 24% bracket. That becomes $178,000 at the top of the 28 bracket for a married filing joint couple. So that's a big difference, right? To where you cross over that next level. All right, folks, it's 10:53. It is the end of this webinar. I hope you enjoyed it. We went over a lot. We talked about the markets, of course. Buckle in, be confident, know your plan. If you have questions for us, if you're a client of ours, and you feel a little uncomfortable, let us know, especially if it's your first year. It's good to have this conversation. If this is the first time you're seeing swings like this, it's easy for us to say it's okay. We build it this way, but there's a lot of feelings that get involved in these things. So reach out to us if you're having concerns. We got big changes coming for the firm, as many of you know, but we'll be busy over the next several weeks. We've got a big year planned, a lot going on, and we hope you're here for the ride with us. I hope these were informative. Let me know if you have any creative feedback for me, or what's the word? Good feedback. Now I'll take constructive feedback, one way or the other. I always like to hear things. If you want me to talk about anything in particular, let me know. Next week, we'll be going over the slide updates, the market updates, and we will be talking about why is cash value life insurance so important. Many of the same reasons, but it's a different animal. So we're going to go into the fundamentals a little bit. Hope you enjoyed it. Hope you learned something, and we'll see you next week. Take care.